Imagine two people, each with $2,000 to invest. The first one hears a company is booming, sees the stock going up, and buys in immediately. The second one asks for 3 documents first, just 3. 6 months later, the first investor has lost more than half his money. The second one has doubled hers. She didn't have some secret insider tip. She didn't have a finance degree. She just knew how to read the 3 documents every company is legally required to publish. And once you understand them, you'll never look at a business the same way again. Those 3 documents are called financial statements. And here's the part nobody tells you. They're not designed for accountants. They're designed for you. Every bank deciding whether to approve a loan reads them. Every investor deciding whether to buy a stock reads them. Every serious business owner reads them before making a single major decision. And the wild thing is, almost nobody outside of finance ever learns how. So people make million-dollar decisions, buying stock, lending money, even accepting a job, based on gut feeling, when the actual answer was sitting in a document they never opened. So what exactly are financial statements? They're simply a company's report card. Not a report card written by a teacher, but one the company writes about itself, following strict rules so nobody can just make numbers up. There are 3 of them, and each one answers a completely different question. One tells you what a company owns and owes. One tells you whether it actually made money, and one tells you where its cash really went. Together, they turn a company from a mystery box into an open book. Let's start with the one people find most intimidating, the balance sheet. Here's the easiest way to think about it. A balance sheet is a photograph, not a video. It captures exactly what a company owns and owes on one specific date, say December 31st, frozen in time. Take the photo a day later, and the numbers might already look different. The left side of that photograph shows assets. Everything the company owns that has value. Cash sitting in the bank. Inventory, which is just unsold products waiting on a shelf. Buildings and equipment. The physical stuff the business runs on. Vehicles, if it delivers anything. Accounts receivable, which is money customers already owe the company for something they bought on credit but haven't paid for yet. And investments, meaning money the company has parked in things like stocks or bonds instead of just letting it sit idle. Then there are liabilities, everything the company owes to somebody else. Loans from a bank, money owed to suppliers who delivered goods before getting paid, called accounts payable. Unpaid taxes, wages owed to employees for work they've already done but haven't been paid for yet. Here's something most beginners get wrong. Liabilities aren't automatically a red flag. A company with 0 debt isn't necessarily healthier than one with some. Sometimes borrowing money is exactly how a business grows faster than a competitor who's too scared to take out a loan. What matters isn't whether debt exists, it's whether the company can comfortably handle it. Finally, there's equity, the part that's left over once you settle every debt. If a business owner put in their own savings to start the company, that's part of equity. If the company made profit in past years and kept it instead of spending it all, that's called retained earnings, and it's part of equity too. When you buy stock in a public company, you're technically buying a small slice of that company's equity. And here's where the magic clicks into place. Assets always equal liabilities plus equity. Always. Every single time for every company on earth. Why? Because everything a company owns had to come from somewhere. Either you borrowed it, liability, or you or your investors put it in yourselves, equity. There's no third option. A company can't just conjure a building out of nowhere. So if you add up everything owed to others and everything owed to owners, it will always perfectly equal everything the company owns. That's not an accounting trick. That's just basic logic dressed up in financial language. And once you truly get it, the whole balance sheet stops looking like a wall of numbers and starts looking like a simple, honest equation. I'm John, and if you're starting to feel like financial statements finally make sense, that's exactly the goal of this channel. Breaking down money and investing into pieces anyone can understand. If that's useful to you, consider subscribing to John Explains Money, because we're only getting started. Now let's talk about the second document, the income statement. If the balance sheet is a photograph, the income statement is a video. It shows what happened over a stretch of time, usually a quarter or a full year. It starts with revenue, sometimes called the top line, which is simply all the money a company brought in from selling its product or service. But revenue is the most misleading number in business because it says nothing about profit. From revenue, you subtract the cost of goods sold, the direct cost of actually producing what was sold. A bakery's cost of goods sold is flour, sugar, and butter. Subtract that from revenue, and you get gross profit. Then you subtract operating expenses, rent, marketing, salaries, insurance, all the costs of simply keeping the lights on. What's left after all of that is net profit, often called the bottom line. And it's the number that actually matters. This is exactly why a company can announce record-breaking sales and still lose money that same year. Huge revenue with even bigger expenses is still a loss. Sales tell you a company is popular. Profit tells you whether it actually works as a business. Which brings us to the third document, and the one that quietly destroys more businesses than almost anything else, the cash flow statement. Here's a truth that surprises most beginners. Profit is not the same as cash. A company can be profitable on paper and still not have enough actual money in the bank to pay its own bills. How? Imagine a business sells $100,000 of furniture to a retailer, but the retailer has 90 days to pay. That sale counts as revenue and profit immediately, but the cash doesn't actually land in the company's account for 3 months. If rent and payroll are due next week, profit on paper won't cover a single one of those bills. That's why the cash flow statement exists, to track real money moving in and out. It's broken into 3 parts. Operating activities show cash generated from actually running the business day to day. Investing activities show cash spent on or earned from things like equipment or property. Financing activities show cash from loans, investors, or paying off debt. This single document explains one of the strangest facts in business. Profitable companies fail all the time, not because they weren't making money, but because they ran out of actual cash to survive the gap between selling something and getting paid for it. So how do all 3 statements fit together? Think of a company like a human body. The income statement is like tracking someone's heartbeat over the last year. It shows performance over time. The balance sheet is like an X-ray taken today, a snapshot of their current condition. And the cash flow statement is like measuring their actual bloodstream. Because you can have a strong heartbeat and a healthy-looking X-ray and still collapse if the blood itself stops flowing. A business needs all 3 to be genuinely healthy, and looking at only one gives you a dangerously incomplete picture, which leads directly into the mistakes beginners make constantly. The biggest one is judging a company purely on revenue, without ever checking if it's actually profitable. Another is ignoring debt entirely, assuming any growing company must be doing fine. Another is skipping the cash flow statement altogether, not realizing a company can be profitable and still be dangerously low on cash. Another is confusing profit with cash in hand, treating them as the same thing when they often aren't. And the simplest mistake of all is reading only one statement and assuming it tells the whole story. The fix for every one of these is the same. Never judge a company on one number or one document. Always look at all 3 together. Let's make this real. Picture a small company called Vantage Bicycle Works. Their balance sheet shows $200,000 in assets, some cash, a warehouse full of bike parts and equipment. Against that, they have $120,000 in liabilities, mostly a loan they took out to buy manufacturing equipment. Subtract one from the other, and their equity is $80,000, the actual value that belongs to the owners once every debt is settled. Now their income statement for the year shows $500,000 in revenue. After the cost of parts and labor, their gross profit is $200,000. After rent, marketing, and salaries, their net profit is $40,000, solidly profitable. But their cash flow statement tells a more nervous story. A big retail chain bought $30,000 of bikes on credit and won't pay for 60 days. So even though that sale is sitting proudly on the income statement as profit, the cash isn't in the bank yet. Vantage still has to pay its own suppliers and staff next week. That's the exact kind of squeeze that quietly kills profitable small businesses. And it's invisible unless you actually read the cash flow statement instead of just celebrating the profit number. That's the real skill here. Not memorizing formulas, but knowing which question each document answers. What do they own and owe? Did they actually make money? Where did the cash really go? Learn to ask all three questions about any company, and you'll understand more about its true health than most people who've been investing for years, because most of them never learned to open the report card in the first place.